Let me paint you a picture. It's a Tuesday. You're sitting on your couch. You've just watched 3 YouTube videos about passive income, 2 TikToks about some coin that hasn't mooned yet, and 1 very aggressive Instagram reel where a 24-year-old in a rented Lamborghini told you, and I quote, "The only thing stopping you from being rich is your mindset." And something inside you, something ancient, something hopeful, something that has clearly not been paying attention, lit up. You opened a brokerage account. You deposited money. And then, with the confidence of someone who has done absolutely no research, you bought something. This video is about what happened next. Welcome. I've been waiting for you. Now, before we go any further, I need you to do something. If you are the kind of person who is completely satisfied with your financial situation, if your money's working, your future is secured, and you sleep like a baby who owns index funds, please close this video. Go enjoy your life. But if you are still here, and statistically you are still here, then do me one favor. Like this video, subscribe to this channel, and turn on notifications. Not because it helps the algorithm, although it absolutely does, but because the fact that you clicked on a video called "I Invest in Regret" tells me you need regular check-ins. Okay, let's actually fix something today. Here's what nobody tells you when you start investing. Investing is not complicated. The concept, in its purest form, is almost embarrassingly simple. You have money today, you want more money later. You put the money somewhere that grows, you wait. That's it. A 10-year-old could understand this. A golden retriever, given the right incentives, could probably execute this better than the average adult investor. And yet, the average retail investor, meaning you, me, your brother-in-law who won't stop texting you about crypto, consistently underperforms the most boring, brainless, do-nothing investment strategy available. But here is what I need you to understand before we go 1 second further on this rooftop. This is not about intelligence. The people losing money in the market are not dumb. They're often brilliant. Doctors, engineers, teachers, people who solve genuinely hard problems every single day. Investing humbles everyone equally. And the actual reason, has nothing to do with how smart you are. It has everything to do with behavior. And behavior, unlike the market, is something you can actually control. Here is exactly what you're going to learn in this video, and I want you to actually listen to this part, not as background noise while you scroll. Actually listen, because I'm about to give you a roadmap that financial advisors charge 4 figures for, and I'm doing it on a crumbling rooftop for free. First, you are going to understand the real reason most people lose money investing. And I promise you, by the end of this section, you will look at your past financial decisions and physically wince. That wince is growth. Lean into it. Second, you are going to meet the 3 traps. These are not market traps. These are not economic traps. These are psychological traps that live inside your brain and have been robbing you quietly for years while you blamed inflation. Third, you're going to get a 1-week challenge. 7 days, 30 minutes total across the whole week. No apps to buy, no courses to take, no guru to follow. Just 7 actions that will change the way your brain thinks about money permanently. And fourth, the one that matters most, you are going to understand, really understand, that building wealth is not a talent. It is not a personality trait. It is not something reserved for people who grew up wealthy or went to the right schools or had the right connections. It is a series of boring decisions made consistently over a long time. That's it. That's the whole secret. Now, the problem. Not the economy, not the stock market, not interest rates, not inflation, not the billionaires, not your salary, not your starting point, though all of those are real and we'll acknowledge them. The primary, foundational, most expensive problem standing between you and financial stability is how you behave when you're scared. Let me show you what I mean. Here is a simple table. Look at this. Actually look at it. The market dropped 10%. That happens. It has always happened. Every single time in recorded market history, a 10% drop has eventually, always, been recovered. This is not a secret. This is public information. You can look it up right now. But when your money is involved, when it's not a chart on a screen, but your actual rent savings, your actual emergency fund, your actual hope, the brain does something spectacular. It convinces you that this time is different, that this drop won't recover, that you specifically need to get out right now while somehow everyone else should stay calm. This is called behavioral bias, and it is not a character flaw, it is not weakness, it is evolutionary biology doing exactly what it was designed to do, protect you from threats, applied to an environment it was never designed for. Your brain cannot tell the difference between a predator and a portfolio loss. It treats both like survival situations, and in survival mode, patience is not an option. But here's the good news, and I mean this genuinely, not sarcastically, which I know is unusual for this video. Behavior can be trained. You cannot train the market, you cannot train inflation, you cannot train geopolitical events or interest rate decisions. But your own behavior, your own responses, those can be trained. Those are yours. And that is where every dollar of real wealth is built.
All right, you now understand the problem. You understand that your brain, your beautiful, hardworking, well-meaning brain, is actively conspiring against your financial future every time the market sneezes. So now, the main idea, the actual thing, the part where I tell you what to do instead of just roasting what you've been doing wrong. And I want to warn you right now, this is going to disappoint you. Not because it's bad advice, but because it is so simple, so profoundly, almost offensively simple, that your first reaction will be, that can't be it. It's it. The main idea has 3 parts, 3 habits. Write them down. Habit 1, invest before you think about it. The single most effective thing you can do for your financial future is remove yourself from the equation entirely. Set up an automatic investment, whatever amount you can actually afford, not the amount that makes you look impressive on a spreadsheet, to leave your account on the same day every month automatically before you can touch it. Your greatest enemy is the gap between your paycheck hitting your account and your investment being made. That gap is where your future goes to die. Close the gap. Automate everything. Become financially boring. Boring is the goal. Habit 2, diversify like you don't know what's going to happen because you don't. Here is something every confident investor needs to hear, and I include myself in this. You do not know which stock will win. Nobody does. The analysts don't know. The hedge funds, who have teams of PhDs, supercomputers, and access to information you will never see, consistently fail to beat the market over 10-year periods. So what do you do when nobody knows which individual stock wins? You buy all of them. That is what an index fund is. You buy a tiny slice of hundreds or thousands of companies at once. When one fails, the others carry it. When the market grows, and historically over long periods it grows, you grow with it. You are not picking winners. You are owning the game. That is a fundamentally different and significantly more profitable mindset. Habit 3, leave it alone. I want you to understand something about compound interest, because people say the phrase, but they don't feel it. Let me show you what leaving it alone actually means in numbers. Steady Sam invested $200 a month. He never touched it, he never checked it obsessively, he lived his life. He retired with nearly $500,000 on a $200 a month habit. Panic Pete invested the same amount, but sold every time the market got scary, and walked away with less than 1/3 of Sam's result. Same money in, radically different money out. The only variable, behavior. Automate it, diversify it, leave it alone. That's the main idea. That is genuinely actually the whole thing. Everything else is noise, and we're about to spend the next section showing you exactly what that noise sounds like, who sells it, and why it has been picking your pocket for years. Trap 1. Meet FOMO. FOMO, fear of missing out, is the reason people buy assets after they've already gone up 300%. It is the reason your investment timeline goes, I'm being disciplined and patient, pause, wait, did that thing just go up 40% this week? Longer pause, I'm buying right now at the absolute peak, and I will never financially recover from this. FOMO works because it weaponizes your social instincts against you. When everyone around you is making money or appears to be making money on Instagram, which is doing the heavy lifting here, your brain interprets your patience as failure, your discipline as missing out, your strategy as stupidity. The antidote to FOMO is a written investment plan made before the hype that you are contractually obligated to yourself to follow. When FOMO arrives, you read the plan. The plan doesn't care about what went up this week. The plan is smarter than your feelings. Trust the plan. Trap 2. Meet panic. Panic is FOMO's less glamorous sibling. Where FOMO makes you buy too high, panic makes you sell too low. And together, working as a beautiful, devastating tag team, they ensure you consistently do the two things you should never do: buy at peaks and sell at bottoms. Trap 3. Meet hot tip. Hot tip doesn't come from strangers. He comes from people you know. Your brother-in-law who did his research, your coworker who made 12% last quarter, the guy in the WhatsApp group who always has something big coming. Hot tip works because it feels like access, like you're being let in on something, like this time you know something the market doesn't. Here is the statistical reality of acting on tips from people in your personal network. You are not getting alpha information. You are getting the end of a chain. The people who actually knew, the insiders, the early holders, they are not in your WhatsApp group. They are selling to your WhatsApp group. The antidote to hot tip is a rule, a hard rule, written down, non-negotiable, that you do not move money based on information from people who are not certified financial professionals with a fiduciary duty to you. Your cousin is not a fiduciary. Dave is not a fiduciary. The guy with the rocket emoji is spectacularly not a fiduciary. Okay, here's where we stop diagnosing and start building. I'm going to give you a 7-day challenge, and before you mentally check out, hear me out. This is not a challenge that requires you to overhaul your life, download 14 apps, wake up at 5 a.m., or become a different person. This is 30 minutes across 7 days. Some days it's 5 minutes, some days it's 10. None of it requires money to start. It requires honesty, and if you've been watching this video this long, I already know you have some of that. Day 1. Write down every investment decision you've made in the last 2 years. All of them. Not to judge yourself, not to calculate the exact cost of your worst decisions, though you may accidentally do that anyway, and I apologize in advance, but to see, in writing, in your own handwriting, the pattern of your behavior. You cannot fix what you haven't faced. Day 2, write your actual investing goal with a number and a timeline. Not, I want to be rich, not, I want financial freedom, which sounds wonderful and means nothing without specifics. A real number, a real year, a real reason. Retirement, a house, your kids' education, put it down. Specific goals survive emotional market moments. Vague wishes do not. Day 3, research one low-cost index fund. Just one. Look at its 10-year track record, look at its expense ratio, and if that number is above 1%, keep looking. You are not picking a winner, you are finding a vehicle. There's a difference. Day 4, calculate your investable amount honestly. $80, $100, even $50. Start with what's real, not what sounds impressive. The amount matters far less than the consistency. The consistency matters far less than the time. And the time starts the day you begin, not the day you feel ready. Day 5, set up the automatic transfer. Day 6, delete your brokerage app from your phone. Not forever, not as punishment, but creating friction between your emotions and your portfolio is one of the evidence-backed strategies in behavioral finance. If accessing your investments requires more than 2 steps, you'll panic sell significantly less. The data is clear. Make it inconvenient to react. Make patience the path of least resistance. Day 7, tell one person. Not to brag, not to teach them yet, just to make it real. Decisions spoken out loud become commitments. Commitments are harder to quietly abandon. Tell someone. Make it real. Start the clock. 7 days, 30 minutes, one decision at a time. That is the whole challenge. That is genuinely actually the whole thing.
The investors who build real wealth are not the ones who never feel fear. They are not smarter, calmer, or more naturally disciplined than you. They are the ones who felt the fear and didn't sell. That's the whole edge. That's the complete secret. 30 years of financial research in 9 words. Feel the fear. Don't sell. Here is your 30-day checklist. Print it, screenshot it, write it on your wall or on your rooftop if that's your thing. 1 action per day, non-negotiable. Let's go. 30 days, 30 actions. Most of them take under 10 minutes. None of them require a financial background, a high salary, or a trust fund. All of them require the one thing that actually builds wealth: choosing to begin, and then choosing to continue. You came to this video with a title that made you laugh, or wince, or both. Maybe you saw yourself in it. Maybe you've made the mistakes we talked about. Maybe you've met FOMO and panic and hot tip personally, shaken their hands, given them your money, and watched them leave. That's not failure. That is the tuition. Every investor who ever built anything paid it in some form. The question was never whether you'd make mistakes. The question is whether you learn from them expensively or cheaply. Investing is not about being perfect. It is not about timing the market, finding the secret stock, or knowing something nobody else knows. It is about showing up consistently, behaving better than your worst instincts, and giving time the space to do its job. The market will go down. Don't sell. Your emotions will panic. Don't sell. Dave will text you something. Do not sell. If this video helped you, if something landed, if something made you wince in the right way, share it with one person who needs it, not to teach them, just to start the conversation. Subscribe if you want to keep going. There's more on budgeting, on debt, on the specific accounts that matter at each stage of life. All of it on this rooftop. All of it for free. All of it with this pigeon. You are not behind. You are not too late. You are not too broke, too uneducated, or too far from where you want to be. You are exactly at the beginning, and the beginning is the only place the whole thing can start.